the way I think of it, it's like the biggest $20 trillion market that no one talks about.
Mm.
So you think about global trade,
Yeah.
about $20 trillion of global trade in goods goes through trade finance programs. Commodity finance is a specialized subset of trade finance, and it's about $4 or $5 trillion.
Okay.
So, as a huge market, it sort of surprises me sometimes that it doesn't get more headlines. But it's not that glamorous. It's kind of boring. And so, when things go well, it doesn't really create the drama that headlines are seeking.
Well, this is the I mean, to be fair, this is the case with almost anything, which is that you never hear about anything when things are going well, and that including any types of finance. And hopefully, ideally, you would never hear about any finance because when you
Warehouse
do,
shipment successfully makes it.
yeah, right.
Yes.
It wouldn't make for, to be honest, as a journalist, I wouldn't probably
Client
report it.
pays receivable on time.
Hello and welcome to another episode of the Odd Thoughts Podcast. I'm Tracy Alloway.
And I'm Joe Weisenthal.
Joe, I think I've told you this before, but way back when I was starting in financial journalism, I really wanted to be a commodities reporter.
I get it. It seems fun. It seems real. It seems like one of the few areas of finance that's like not just a screen. You know what I'm saying? Where there's more
there's
to
a
it.
physicality
Yeah,
to
yeah.
it, right?
Yeah, but also like everyone's like, this is a relationship business. But I feel like commodities. Everyone in finance says that, right?
Do your banker impression
this
again.
This is a relationship. But right, but. Everyone says that in finance. This is a relationship business. But actually, commodities seems to be one of those areas where actually that's a real thing and not just a cliche and stuff. So I get it.
It seems to be very idiosyncratic, where
Yeah.
like one load of whatever
Yeah.
commodity might not be completely fungible with
Isn't
the
that
same
funny?
commodity. Yeah, it's
Because we call it commodities.
right.
And yet,
And
maybe they're not.
but so I had this like romantic
Yeah.
idea in my head of what a commodities reporter actually does, which is like, I don't know, go on ships and
Yeah.
travel alongside like huge things of coal and
Yeah.
metal and aluminum and stuff like that, which is probably not realistic. One aspect of commodities that I never really appreciated was how much financialization there actually is
Yeah.
in the market, and that there are so many different players in the
Right.
market. We've sort of touched on it before with the Strait of Hormuz situation where
Yeah.
you have the insurers and then you have the reinsurers and you have like insurers for the freight and for the hull
Yeah.
and for like liability. And it just seems so complicated. You have a very similar situation on the financing side.
Sure.
And it struck me that we have never actually done a commodity financing episode.
No, and I'm really interested in this because, again, like one of these things, you always hear about capital efficiency, right?
Mhm.
This is very important. And so, okay, here's like, let's say we do not know, I don't know what the cost of moving so and so many kilograms of copper from one place to another is. Whatever that cost is, I probably don't want to tie up all of my capital
Right.
at that. I probably want to put down a fraction of the thing, borrow the rest, et cetera, then pay off that loan when the ship gets there, et cetera, so that I'm as liquid as possible at any given moment. This is just like, I'm sort of like, this is my first principles. I don't know anything about this space, but I assume that there are a lot of calculations like
Yeah.
this within the process of procuring, mining, delivering commodities.
Absolutely. So today we are going to learn about commodity finance. We're
Great.
also going to try to get a handle on what's going on in the commodities world right now, given some of the disruptions that we've seen. And I'm glad to say we do, in fact, have the perfect guest. We're going to be speaking with Lewis Hart. He is, of course, the head of corporate advisory and banking at Brown Brothers Harriman. So
Amazing.
someone who lives and breathes commodity finance.
Thanks, Tracy. Thanks, Joe. It's great to be here.
Would you say you know more about commodity finance or 90s hip hop and R&B?
Ooh, that's a tough one. Very close. Very close.
I'm throwing that out of nowhere. He's a big
really?
hip hop guy.
Tracy
yeah.
knows me well.
Interesting.
Tracy
Oh,
knows
wow.
me well.
We just go back and we just talk about that.
No, we
could just
shouldn't.
go.
Okay, what's commodity finance? Like, what exactly are we trying to achieve here?
It's a good question. And the way I think of it, it's like the biggest $20 trillion market that no one talks about. So you think about global trade,
Yeah.
about $20 trillion of global trade in goods goes through trade finance programs. Commodity finance is a specialized subset of trade finance, and it's about $4 or $5 trillion.
Okay.
So as a huge market, it sort of surprises me sometimes that it doesn't get more headlines. But it's not that glamorous. It's kind of boring. And so when things go well, it doesn't really create the drama that headlines are seeking.
Well, this is I mean, to be fair, this is the case with almost anything, which is that you never hear about anything when things are going well, and that including any types of finance. And hopefully, ideally, you would never hear about any finance because when you
Warehouse
do,
shipment successfully makes it.
yeah, right.
Yes.
It wouldn't make for, to be honest, as a journalist, I wouldn't probably
Client
report that.
pays receivable on time.
Yeah, client pays receivable on time. When I think about finance generally, I think about like who is a consumer of financial services and what services are they actually, I guess, purchasing, or when do people find the need for finance, right? So a homeowner occasionally needs financial, or a home buyer suddenly is a purchaser of the financial services through a mortgage, right?
Yeah.
Et cetera. What is a canonical or modal example of a consumer of commodity finance?
Sure. Well, it's really the business of financing motion. And
Okay.
so the classic example would be a commodity merchant.
Okay.
Commodity merchant kind of evokes a lot of history, right? You
Yeah.
think back to Renaissance Italy and the Medicis and all the merchants that kind of pioneered global trade in those
Yeah.
days. And actually goes back even farther. You can go back to even the BCs and see trade finance happening. But the typical consumer is a physical merchant, and
Okay.
they may be in the energy space, they may be in the metal space, or they may be in the agricultural space. Their job is not to speculate on prices,
Right.
contrary to popular belief. You think commodity trader, most people think speculation. That's
Yeah.
actually not what they do. They are essentially supply chain managers. That's their
Mhm.
role. And they are the largest consumers of commodity finance.
And what are they purchasing?
They're purchasing, you said it well at the beginning, shiploads of copper cathode, containers of coffee, green coffee, unroasted coffee in burlap bags.
No, but like, so sorry, just to clear, when I get a mortgage,
Yeah.
I am purchasing the ability to have a minimum monthly payment that's spread out over 30 years.
Yeah.
So that is what, when I interface with the bank or whatever, a mortgage broker, I am purchasing the ability to not destroy all my liquidity when I buy a house. So what are they, not setting aside the commodity that they're purchasing, what are they purchasing from the bank?
Yeah. So essentially, the basic product is a line of credit,
Okay.
a secured line of credit. And that line of credit, kind of like a credit card, can be used to buy eligible commodities.
All right.
So it's a line of credit that's self-liquidating, meaning once you make the loan, you know what the client's buying and you know what the source of repayment is. That's very different than other types of lending that take much longer to repay.
Okay.
So it's very short term, it's self-liquidating, and it's secured by inventory.
Mhm.
And then when the inventory is sold, it's secured by the account receivable that results from the sale of the inventory. The receivable gets paid, and then it keeps happening again and again. It revolves up and down. The big variable that is always tricky is what's the price of that commodity at the time of the loan. And these structures are designed to give clients flexibility to buy the copper, whether it's $6 a pound, $4 a pound, $7 a pound. It's hard to predict these
Yeah.
capital needs, and that's most lenders like fixed amounts. This is a floating dollar amount, which is kind of a unique part of it, where the value of the loan changes as the price of the commodity changes.
Oh, that's interesting. Wait, okay, so why do they need that flexibility?
Yeah. Explain that further.
Yes. So, good question. So, think about a client who's buying a pound of coffee, right? Think about your local coffee shop here. That coffee bean traveled 2,000 miles from somewhere likely in South America. It went through a whole process of milling and exporting. It went on a ship. It ended up at a roaster in the US and finally made its way to a retail shop in Manhattan. There's a ton of capital involved there. That client likely agreed to buy that coffee several months in advance. The time when they actually fix the contract and pay is when the coffee ships typically. And at that point, we don't know if the price is going to be $3 a pound, $2 a pound, $1 a pound. And so the capital needs, you kind of can figure them out within a band, but sometimes things happen that actually change what you thought. And so the unique thing about a commodity lender is they're marking to market that inventory. So if you pledged me a pound of copper, I'll lend you 75 cents, 80 cents, maybe more of the value of that copper, whether it's $3 a pound, $3.50 a pound, or $2.50 a pound.
Where does the commodity futures market play into this? Because when we're talking about the unpredictable nature of, we don't know, the price of commodities fluctuate, you can lock in prices in many commodities and not all. And I want to get into that,
Yeah.
the financialized commodities. But to some extent, doesn't the futures market solve part of the problem of the variability of the pricing?
It does. It solves in one sense. It solves the price risk. So one of the
Okay.
key risks in commodity finance is the price risk. So if I'm lending against copper
Yeah.
and the price goes down, I better be careful, right? My capital could be impaired. So you use the futures market, the
Yeah.
derivatives market, to hedge that price risk. So we like to say our clients are typically long physical, meaning they own the inventory,
Okay.
and they're short paper, they're short futures contracts. That works really well. But when prices go up, that means they have to post margin calls. So if I have a $3 a pound copper
Oh,
shipment
yeah.
and the price goes to 350 while it's on the water coming from Chile to Georgia, that client says, I need to borrow more money to keep my hedge open.
Yeah.
And until the ship arrives and the client pays for the copper, that hedge is on, and you don't know what that margin call is going to be.
This is what happened with like nickel a few years ago, right?
Yeah, I
Where
think
you
so.
had entities that were long nickel and still got destroyed by the margin calls that they experienced, even though they were on
Unlucky,
on some
unlucky.
level on there, they were on the right side
They
of the
were on the
trade.
right side.
Yeah.
This is a slight tangent, but you brought up coffee just then. I think both of us read Lloyd Blankfein's book in preparation for having him on the podcast, and he was talking about how when he was at J. Aaron, they had the huge warehouses of coffee beans, and apparently they smelled really bad because
Oh,
they
weird.
would like rot, I
Oh,
guess, or like there'd be
seems
bugs.
unoptimal.
Yeah.
Yeah. What are you doing? Yeah.
Is that true? Do coffee beans actually smell bad in large
I
amounts?
mean, I like the smell. I've walked through many coffee warehouses.
Yeah.
There are a lot of them in New Orleans. There are a lot of them in New Jersey. They're basically burlap bags full
Yeah.
of green coffee,
Yeah, that should smell
unroasted.
good,
It smells
right?
pretty good. So
Yeah.
I'm not sure about that story, but the good warehouses store them well. They don't really degrade that quickly. You know, they have a pretty good shelf life
Huh.
and they can last for a pretty long time before they start to decay. But you have to keep moisture away. There are things you have to do to secure the quality of them. And the good warehouses are expert at handling those bags of
Okay,
coffee.
so this is actually a serious question then. When you're doing due diligence for a loan, what are the factors that you're taking into account? Would you look at something like the quality of the warehouse that commodities are going to be stored in?
Absolutely. You would look at you would have location eligibility requirements. So you'd say, I will lend against coffee that's in this warehouse, or this warehouse,
Hmm.
but not coffee that's in this warehouse for whatever reason. So that's a big part of your diligence. That's one risk. The bigger risks are really what we touched on, price risk.
Mm-hmm.
Counterparty risk is the second one. International risk, which I'm sure we'll talk about. Where is the good that you're financing? Hopefully it's moving.
Yeah.
Sometimes it may not be.
Not at the
And
moment.
yeah, exactly. In some cases it may not be. And the biggest one I think that Brown Brothers Harriman particularly focuses on is the management, the owners of the business. What are their motivations? What's their reputation?
Hmm.
What's their character? We have something we call the 5 C's of credit. It's kind of an old adage. And those are character, collateral, capital, conditions. And the most important one we think is character, the character of the borrower, which really comes out when markets get volatile, how
Oh,
people
yeah.
behave. And these are, you started saying accurately, this is a super relationship focused business. Character is really the most important thing in the business when you boil it all down.
Sorry, just to be clear here, when we're talking about, okay, a client comes and whatever they have a need for some coffee or whatever, the other side, is this coming off of Brown Brothers Harriman's balance sheet, or are these loans, or do you find other, are you a middleman for this, or is it your own balance sheet, or both?
So it's historically, this market was dominated by banks. There
Okay.
was sort of a group of banks, particularly European banks, that dominated. I would say in the last 10 years, many of those banks have actually stepped away from the market for a variety of reasons. And as a result, there are not that many in the US who really specialize in this.
Yeah.
We're one of them. But there are plenty of European banks that really understand this business. And what we've seen is you're seeing more and more interest in this asset class from institutional investors. So they
Yeah.
like short term, floating rate, inflation protection, uncorrelated to the broader equity markets. There's some really attractive features in this.
Yeah.
It's historically been a very small group of banks, but it's starting to expand into the institutional investor world.
So are you reselling that risk in many cases?
We're typically holding the majority of it,
Okay.
but we will syndicate risk out to other investors from time to time as well. And we have some partners that we work with. We have different banks that will essentially buy risk from Brown Brothers, but we're always holding a significant portion of the risk on our balance sheet.
Hmm. And how come the banks have exited the business? Is that just like a 2008 regulatory capital
It's
story or
it's
something else?
definitely a Basel story to some extent.
Yeah.
I think as Basel IV has kind of taken hold, you see more and more capital requirements that make it harder to issue letters of credit and things like that. So that's definitely part of it. I think another big part of it is just the administrative intensity of running this business. If you think about tracking all this collateral as it's moving around the world, you need people. Now,
Hmm.
over time, digitization is going to take hold here, but you still need know-how, you need people, and it's not easy to kind of run this business every day if you don't have the right people. We're fortunate to have a very experienced team that knows how to do this. We started 206 years ago in this business, so we've
Wow.
literally been doing it for over 2 centuries, and that's a big part, I think, of why we've stayed committed. It's kind of the DNA of
Hmm.
our firm. I think, over time, you're seeing some banks coming back into it, but you also saw in the energy space in particular, first of all, big problems in 2015 during the correction. Banks lost some money. And then you had ESG pressures, particularly around European
Oh
banks,
yeah.
that caused some to say, I don't really want to be in the business of financing this commodity or that commodity.
Hmm.
I'm going to shift my resources more to the renewable sector, for example. So those are, all the factors that I think have contributed to it. But there is a group of banks globally that has stayed committed to this business through kind of thick and thin and knows how to do it, has produced good returns, very low losses over time.
You mentioned tracking commodities and shipments. How do you do that exactly? And is it different to what I can do?
Maps go.
Yeah, Maps Go is
Okay.
pretty cool. I was looking up something the other day. It was a cargo of fertilizer
Yeah.
leaving Saudi Arabia. It was pretty easy to see like where the ship had left from and where it
Yeah.
was going and whether it was on time. So what exactly are you doing?
So, the bill of lading is like, I call it the talisman of trade finance. It's this really cool document. It's a title document when it's negotiable. So there are 4 words to the order of that. When those 4 words are printed on a bill of lading, that means that whoever to the order of the word after that, they essentially control those goods.
Hmm.
Those bills of lading have numbers, and you can type those numbers into, for example, Bloomberg Terminal has the Marine Tracker app. We look at that. So we're using public source data to really track that collateral when it's necessary. You typically don't need to do that unless something's going wrong, because ships tend to go where you think they're going to go. But that is a tool with technology that makes it much easier to actually track your collateral while it's on the water. Once it goes into a warehouse, you typically get a warehouse receipt, which also can be a title document, very important if it has those 4 important words. And in that case, you're often talking to the warehouse directly.
Hmm.
So you may say, the client may say, I'd like to release these 5 bags of coffee or 1 cappuccino to sell to, this roaster. Is that okay? And our team is actually saying, yes, please release those. But that's on trust, what we call a trust receipt. And then they have to give us an account receivable to replace that
Hmm.
within a certain number of days.
Interesting. Okay, so obviously in the backdrop of this conversation is the closure of the Strait of Hormuz, and we'll get to that in a second. But it does raise a question I sort of hinted at in the beginning. We all know that oil flows through the Strait of Hormuz, and there's a futures market for it that allows some ability to reduce volatility or take out concerns. Pistachios also flow through the Strait of Hormuz. There's no, as far as I can tell, there's no pistachio futures. I just looked it up on the terminal. And I'm curious, first of all, do you do commodity finance for commodities that don't have hedging instruments?
So one of my colleagues, this may shock you, is on the board of the Peanut Tree Nut Association.
Oh.
And so
Is it actually called the
it's
Peanut
called the
Tree Nut?
Peanut Tree Nut Association. It's a big trade organization, and we happen to
Peanuts
finance.
aren't tree nuts, hence the name has to be
Yes,
segregated
you
out.
need
Yeah.
peanuts and tree
Yeah,
nuts in the
interesting.
title. It's very, very important, very specific. So we actually are active in lots of non-hedgeable commodities,
Yeah.
like cashews is a good example, pine nuts, pistachios less so,
Okay.
but all kinds of non-hedgeable commodities that would probably surprise you.
How does that change the calculus of commodity finance when that instrument doesn't exist?
Thinking about what's happening in the Strait, first of all, we're not the largest player in the Middle East. I think
All right.
more the European banks, but certainly we're watching it
Yeah.
closely. And I think what the media is really focused on is kind of the oil side of the story. So you keep hearing 20% of global oil
Yeah.
is trapped, the largest disruption in the history of the oil market. Those are all true. You see lots of activity in the price, although it's mostly in the front of the curve, not in the
Yeah.
back of the curve. What I think we're interested in, actually, in the lens of a commodity banker versus the lens of sort of an oil research analyst, is how much capital is actually trapped, right? Because our business relies on turning over your balance sheet. The
Mhm.
commodity merchant and the commodity banker, the fundamental principle is that self-liquidating nature. So you buy it, you sell it, you collect, and then you do it again.
It's velocity of money,
It's the
right?
velocity
Yeah.
of the turnover. And right now, there is a lot of capital that's stuck in the Strait. And
Mhm.
I see lots of different reports. Is it something like 1,500 commercial vessels, some number like that? I think that's what the Pentagon said recently. That's a lot of working capital. So, doing some rough math, that's tens of billions of dollars. Maybe it's more than 100 billion, but it's a massive number. And when all that gets trapped, and you have potentially margin calls related to
Yeah.
hedges on those inventories, that can really strain your liquidity if you don't have the right financing structure behind you. And that's why in these situations, you need a bank that understands your business. So if you were going to load an Aframax, which is like typically 700,000 barrels of oil, that's
Yeah.
the capacity of an Aframax vessel. Before February 28th, the cost of that might be 40 million, 45 million dollars. Today, it's more like 70, 75 million dollars. And so overnight, the cost of your single shipment went up a significant amount. And how do you finance that? Back to the earlier point, you need a bank that can be flexible enough to write a line of credit that allows you to do financing under a certain
Yeah.
guideline.
So, how are the banks actually handling this at the moment? Because on the one hand, like, okay, the cost of actually shipping stuff has gone up. On the other hand, the value of the underlying collateral, assuming it's oil or maybe steel or something like that, has also gone up. But on the other hand, as you point out, balance sheets are probably a little more restricted if you have these huge sums that are already tied up because the ships aren't actually moving.
Going back to COVID and then Russia, Ukraine, first you had this huge supply chain disruption. We all remember images of container ships off the coast of Long Beach. 2 years later, we had the Russian invasion of Ukraine
Mhm.
and this huge disruption in natural gas flows from Russia to Europe. And those people didn't forget about those things. So companies went out and raised more capital
Hmm.
so that they were ready for the next exogenous event. So I think
Sorry, when you say companies.
commodity merchants,
Okay.
in this
Yeah.
case, yep. Commodity merchants specifically went out as a result of the volatility in those two events, raised more capital. So they're coming into this crisis well funded. And so far things are working okay, actually. There's not
Huh.
evidence that things are breaking. If this lasts for months and months and months, who knows where it goes. But right now the system is functioning well, actually. The banks are supportive. The commodity merchants are dealing with the liquidity needs. They have enough liquidity. We haven't heard of any major issues yet, but it's a matter of time. And if the Strait doesn't open sooner than later, then I think you could see, big strains because there's so much trap capital there.
What actually happens mechanically if I've financed a particular shipment and it is now hypothetically stuck in the Strait of Hormuz? Like, what conditions start to kick in?
If you're channeling your inner commodity banker, the first thing you're looking at is my collateral okay, right? So if it's a shipment of oil, is, the crew okay? Is the ship in the right place? Is it going to be at risk of, being in a war zone and having impairment? Once you sort of get over that, you're looking at the insurance, making sure the insurance coverage is there. You're looking at what does the charter contract say between the merchant and the ship operator, and that's going to govern sort of who pays for this detention, voyage frustration. They're different terms, but all those are going to be
Is
governed.
voyage frustration an actual term?
Yes, frustration of voyage. Yes. And so this is, demurrage is a common term. That's when the merchant is slow to load a vessel or slow to discharge a vessel. This is something a little different because this is essentially a war zone. The ships can't leave. And so it has happened historically, but it hasn't happened in a long time. And I know everyone is sort of looking at the contract, figuring out what the losses and costs are, and then figuring out who's responsible for what. It's not a single answer. It's case by case. But first you're looking at the collateral, then you're looking at, does my client have enough capital to withstand this? How many months, days, hopefully years could they withstand if this actually never opened?
Do you do what would be the equivalent of workouts with clients? I mean, here is clearly something that's not their fault. It's an exogenous shock and so forth. You probably would like to have that client be with you 5 years from now when hopefully the straits open in 5 years and so forth. And so you have here's money some owe us, but this would be really stupid to put the screws to you now to collect that. Maybe they have the capital, could make the payment, but it would be very unwise in the long term to put the screws to the client to get that payment back, given that life is long and so forth.
Yeah, we operate under the principle that you don't put all your eggs in one basket. So supplier diversification is a really important part of commodity risk underwriting. And that means if a client has 100% of their supply coming from one region, you might get a little anxious about that credit and say, maybe not for us. So typically there's enough diversification that a single ship or series of ships that are stuck in one place doesn't cause the company to kind of seize up. There may be some of that out there, but we're not seeing that with our clients.
I'm sorry, I want to just go back to something because I didn't understand. So you mentioned your colleague who's on the Peanut Tree Nut Association.
Yes.
How from the perspective of Brown Brothers Harriman, how does commodity banking or finance work differently for some of these more niche commodities where the client does not have the ability to go short to contrast the physical?
In non-hedgeable commodities, you're also measuring price risk. Typically, in something like cashews, as an example, cashew supply chain is super interesting, by the way. It starts typically in West Africa. It comes in something called raw seed. It then gets shipped to Southeast Asia, Vietnam, India, and they extract this kernel. And the kernel is what you eat, and there's actually toxic liquid in between the shell and the kernel. Long story, but it's sort of a fun supply chain, and then it gets exported in edible form, typically from places like Vietnam. And so it's a very long supply chain, and typically what you're relying on there, because the price does move a lot, is a forward contract. And that forward contract may not be financially settled as it is in the futures market. It may be, I've sold this all to XYZ buyer at ABC price.
Some maker of sweets or something like that.
Think about if you like cashews, if you go to your local grocery store, it's probably whoever sits in between your local grocery store and our client that is packaging and salting and all those things.
I'm fascinated, Tracy. Oh, what?
So I was looking up the toxic liquid that comes from cashews, and it's urushiol. I'm not sure I'm pronouncing that right, but the stuff that comes from poison ivy, which I am currently suffering from. So this is Yeah, this is interesting to
That's
me.
really interesting to know. But it's interesting too. Like I remember when we were in Alaska, um, we were talking about some of the fishing that happens out there. How much fish goes to Asia
Oh,
first to
yeah,
be
for processing.
processed,
Yeah.
and it's really interesting to think from just like these pure commodity standpoints,
Yeah.
how I imagine a lot of the value add of the supply chain is not actually accruing to the original origin of the commodity, but rather the entity that can do processing most efficiently through some combination of technology, environmental standards, um, labor costs, and so forth. I imagine a lot of the value add in a, say, cashew comes there.
Yeah, it's I'd say a lot of the value is happening kind of in the midstream, to your
Okay.
point,
Yeah, yeah.
in between the upstream, which would be the farm,
Right.
for example, in West Africa, and the client at the end,
Yeah.
the
Interesting.
retailer. So
Mm.
that's definitely true. Interesting fact about the peanut tree nut market is that it's also
Sorry.
full. I want to keep saying that. It's full of family businesses. And the other thing we do a lot of is work with family businesses. So you sort of look at this intersection of commodity trade finance, family business, and in the middle of those two overlapping circles is the peanut tree nut industry.
Got it. Huh.
Just going back to collateral, one of the tropes or jokes that often gets brought up in commodities markets is like, I put on a physical oil trade and like, oh no, now I'm going to have to
Yeah,
actually
yeah.
settle and take delivery of like 50 barrels of oil in my studio apartment or something like that. If you're in commodity finance, is taking delivery of actual collateral like, is it a disaster for you the way it is for other investors, or is it kind of that's what it's there for? These are all collateralized loans.
Usually you wouldn't take delivery if you didn't intend to. So usually it means something went wrong. There are certain products where you actually buy the commodity physically with a contract to sell it back in the future. It's a form of inventory financing called a repurchase agreement. But typically, your goal is to manage the credit so it's a good company that doesn't default on the loan, and therefore you avoid having to get out of the loan the second way, which is liquidating the collateral. So you try to avoid that at all costs. If you had to, the good news is you can typically sell it in the location where it exists. So
Mm.
if it's in a tank in Houston and it's X barrels of oil, you kind of say to someone else, "Hey, can I sell you this? It's sitting here," and they'll quote you a
Hmm.
price. So it's not as dramatic as actually arriving at our doorstep.
Right.
And we try to avoid having to do that.
Mhm.
That's part of our job. Something has gone wrong if we're doing that, but it has happened before over our 206-year history.
Once again, going back to unhedgeable commodities, and I asked this for a different reason, is one of the things, and it's sort of commodity-ish, one of the things that's very hot right now, or a lot of people are hoping that compute futures are going to be a thing, and that people will trade capacity of an H100 NVIDIA chip in the way, and there are some nascent efforts, and I don't know if this is going to take off,
Yeah.
but I'm curious, like, if there are any intuitions that we can build based on existing markets of what types of commodities lend themselves to financialization in that way. So we have oil futures and we have cotton futures, but we don't have pistachio futures. Is
Yeah.
there anything that we can look at and say, yes, this type of market lends itself to financialization on an exchange, whereas this one doesn't? So as in our minds, we can help try to predict whether this will logically apply to something like compute futures.
Yeah, so if you look at the origin of the futures market, it was really designed to help farmers manage their price risk. So think of a grain farmer in Iowa
Yeah. This
planting,
is what they teach you in the textbook. The
yeah,
farmer
the
and the
farmer and the
yeah.
hedge and all
And they
that.
bring it to
Not the
market.
onion
Yeah, yeah.
farmer.
But if you look at the properties of the
Yeah.
commodities that kind of lend themselves to futures, I think it's a few things. One is how homogeneous is the
Okay.
product. So the more heterogeneous the product is, the harder it is to standardize into a
Yeah.
financial contract. Two is volatility. If there's no futures market and it's moving all over the place, there's going to be a lot of demand from a producer, from an
For a
end
futures
user
market.
for a futures market. So actually memory chips and compute are extremely volatile right now. We've been thinking a lot about whether that's a good candidate for
Yeah.
a futures contract.
Oh, interesting.
And if you're a fab that's producing chips right now, you love the price you're getting,
Sure.
right? I mean, maybe you've sold some of it forward below the market, but as you're kind of rolling your contracts, it's very profitable, right? And could you lock that in? On the other side, if you're an electronics consumer of chips, you'd love to be able to hedge that price
Yeah.
and hedge your consumption. So I actually think it's a great candidate for the futures market. Whether it takes off, I'm not
Yeah.
sure, but I know some of the exchanges are spending a lot of time on this right now.
Yeah.
So
I don't know when this particular episode is coming out. We're recording on May 27th, but very soon at our live show,
That's
we
right.
will
On May
have
28th. Yeah.
we will have an episode dedicated to, hearing from one company that is trying to create a compute exchange and futures market, basically. So that'll
Yeah.
be interesting.
Yeah,
Yeah.
I'm very interested in this question.
I think part of the big story with compute, by the way, that's underfollowed is copper. So
Mm.
I think everyone talks
Oh,
about
yeah, yeah.
power, and
Right.
power is really important, and there needs to be lots of power capacity in order to build the AI revolution. Copper is as important, and you see copper prices
Yeah.
at record highs, largely because of how much copper data centers are consuming because of all the electrical capacity that needs to be in that
Yeah.
infrastructure.
Commodity financiers, do they have good insight into like trends in commodity prices just by virtue of being able to see like actual supply and demand on the ground?
In general, our philosophy is we don't know where the price is going. So we try to be price agnostic,
Mm-hmm.
but you can't help but notice trends, see things early. And one example would be in 2020 when COVID hit, you just saw freight prices skyrocketing. I think
Yeah.
well before the market, you saw things like steel going up quickly and those prices being passed down the supply chain. So you definitely can see things that kind of feed into like the PPI, ultimately the CPI. When you live upstream the way we do in kind of these metal, energy, ag supply chains, you often see things first and
Mhm.
before they actually get transmitted into the economic data. Now, it's just one side of it, so it may not be conclusive, but it certainly provides us with lots of interesting information.
The immediate post-COVID period and freight prices, you mentioned, they surged. There's not a trucking capacity futures market, but it
Not
occurs
yet.
to me like, okay, here is a situation in which you have this sort of idiosyncratic moment, and then it probably wouldn't have made sense. I don't know. Trucking, like, is it in your mind, like, could that eventually be a candidate for?
Yeah.
Because you have these explosions of price. And so in the explosion of price moment, probably everyone's like, oh, I wish I could hedge this, right? But then you don't really know, is this a permanent fixture or is this just a post-COVID thing where there was a one-time price readjustment? Because if it's a one-time price readjustment, you don't really need a futures market.
Yeah.
And we don't really know, like, from memory, is this like a one-time price readjustment or is this a new permanent fixture of the memory landscape? But answering that question would be an important part of whether it's worth it to build out a futures market. But I'm just curious, like in the post-COVID environment, were there people kicking around the idea of freight futures or something like that?
Yeah,
Because
and
it's like
there
this, so
are
everyone awakes to this volatility.
there's not super liquid, but there are tanker contracts you
Yeah,
can
I just noticed
buy.
this. Cape says, but it looks like there's almost no liquidity.
Yeah, there's not, the bid ask is pretty wide, but
Yeah.
people do try to make markets. So dry bulk freight, you can go long or short. Trucking, I think, is a good candidate for it. I think because trucking in a lot of ways follows the diesel market, because the biggest kind of
Yeah.
variable cost of trucking is
So there's
diesel
already an instrument
consumption.
to hedge that.
A little bit. It's not perfect, but it's pretty highly correlated. So
Tracy hinted at this in this. Were onion futures to be legalized? Would onions themselves? So you mentioned
Now we're just doing hypothetical
this
futures
is
markets.
you mentioned there are two conditions: that high price volatility and homogeneity of the underlying commodity.
yes.
Would onions meet the conditions such that were they to be legalized, they would be a good candidate for financialization?
Well, one thing I'd worry about with onions is perishability.
Yeah, right.
So I think putting onions in a warehouse, if you had a physical settlement
Yeah.
process, could be a little dangerous, because you can only store them for so long.
Yeah.
But onions, they are pretty homogenous
Okay.
as far as I know. I mean,
All right.
maybe I'm missing like a specific
Well, specific
green
type
onion.
of onions,
Yeah.
white
So there's some
onions.
basis risk.
Yeah,
You know what my
maybe.
favorite onion is?
Yeah.
The Texas 1015. Do you know what that is?
No.
It's
I've never heard of that. What is
yeah,
that?
it's a type of yellow onion that I think was created at Texas A&M University. It's really sweet and tasty.
I have to
Sounds
try that.
fake.
No, I mean
Sounds like
it's like any other.
Texas A&M
No,
propaganda.
believe me, I would be the last person to advocate for Texas A&M propaganda. No, look up Texas 1015. It's a really nice onion.
And I've got big onion growing
Oh my
plans
God, it's
this
the
year.
official state vegetable of the state of Texas, according to Google's AI overview. So I have no idea if that's true.
No way. I'm gonna have to
Yeah,
try
it's
this.
worth.
All
Yeah,
right.
no, they're good. They're
All
good.
right. Well, we're learning
Texas
all sorts of
1015s.
things in this conversation. I just want to go back to the idea of seeing some trends before they kind of burst into the public consciousness. So, one of the reasons I was tracking a ship last week was because it was going with its payload of fertilizer. It was going from Saudi Arabia's Yanbu port to Bangladesh. So basically, they had trucked a bunch of fertilizer from the like Gulf side of Saudi Arabia over to the African side of Saudi Arabia, and we're going round. Are you seeing any new like trade routes being established as a result of what's going on in the Strait of
Yeah, and
Hormuz?
great question. I think we saw that starting actually with the Houthi issue in the Red Sea. And if you think about voyages, for example, from Shanghai to Northern Europe, take that route, which is a pretty big route, they used to go through the Suez Canal. Suez Canal kind of closes because ships are not comfortable taking that risk. Suddenly they're now routing around the Cape of Good Hope. And back to my point on kind of this age of bottlenecks and disruption, that's adding, 10, 15, maybe more in terms of shipping days, which adds to the working capital requirement, adds to the cost, the day rate on the ship, the insurance. So absolutely seeing a lot of that. And I would guess if the Strait of Hormuz conflict continues for a lot longer, there's going to be a lot of creativity in terms of how to discharge cargoes from those ships, get them to safer ground, and then export them in some other way. I would imagine if I were Saudi Arabia, I'd be thinking about building pipelines, going the other direction. I'm sure that's happening all over the Middle East to try to avoid the strait. Even if it does subside, I think people are still going to want to find alternatives because we've realized how reliant we are on this one choke point.
All right, Lewis Hart, thank you so much for coming on Odd Lots. That was so
Thank
much
you.
fun.
It's great
That
to
was
be
great.
here.
That
Learned
was a lot of fun.
Yeah. Joe, I always enjoy those commodity
Yeah.
discussions. I feel like I learn a lot of things like that urushiol is also found in cashews. I
Yeah.
had no idea. And it sucks when it gets on your skin because you've been gardening.
I also learned that there's a peanut tree nut association. I learned about that.
Why didn't they call it like groundnut tree nut association? Are there just like not enough popular groundnuts?
Is peanut a groundnut?
That's what I thought.
I have no idea.
Doesn't it grow on like
I have no idea. No, I did think I love that conversation. I guess,
Yes.
commodity, as you said, there's a sort of romantic, exciting element of commodities that's very real. I mean, it still exists. The fact that you're having to like reroute trade flows in real time.
Yeah.
The
Now you're
fact,
seeing new trade routes established.
you know what I want to do an episode on is Asian food processing. Because it's really interesting to think about commodities are grown all over the world, or agricultural commodities in particular are grown all around the world. But essentially, will more and more of our food come from East Asia, even though we don't think of East Asia as being a big agricultural powerhouse per se.
Well, the
It's like
Alaska
a really
fish stat blew my mind
Yeah.
when we heard it last year. Also, okay, so I just Googled this. I feel like we've been doing a lot of like searches during
Yeah.
this conversation.
That's actually a sign of a good episode.
But apparently peanut is just another word for groundnut. I always thought peanut was a type of groundnut,
Oh,
but it turns out they're just like
they're
interchangeable
synonymous.
terms. Yeah. So in Asia and India, they'll talk about groundnut oil, which is just peanut oil.
Interesting.
We're learning a lot.
There you go.
And one other thing I wanted to say is, it's becoming a cliche at this point, but Lewis was talking about the idea of all this capital tied up in the Strait of Hormuz, right?
Yeah.
And
Oh,
like,
yeah,
it's
right.
okay now, but
But in a few months.
but the longer it goes on, like the more problematic it becomes. And this seems to be like the overriding theme of this entire shock, right?
Well, it's interesting. Yes, absolutely. Because we're recording this May 27th. So tomorrow will have been the 3-month start of the war.
Yeah.
I don't know when this episode is coming out. But It's also interesting to think that, a couple months ago when we
Hmm.
were doing commodity episodes, we would say like the exact time of the episode, like, oh, we're recording this at 10:30.
Right.
But now it just feels like this is just this interminable thing that's part of the background. We're actually so deep into it that it's just like, yeah, it's probably going to be closed a year from now too. And it just feels like no one even, it's like this has now become it has this feeling of permanence that now it suddenly becomes, yeah, I suppose things could change by the time this episode comes out, but it almost feels like it probably won't.
Yeah,
If you
we've
know what I
definitely
mean.
stopped doing the minute by minute timestamp. Okay, shall we leave it there?
Let's leave it there.
This has been another episode of the Odd Lots podcast. I'm Tracy Alloway. You can follow me at Tracy Alloway.
And I'm Joe Wasenthal. You can follow me at The Stalwart. Follow our producers, Carmen Rodriguez at Carmen Armin, Dashiell Bennett at Dashbot, Cale Brooks at Cale Brooks, and Kevin Lozano at Kevin Lloyd Lozano.
And for more Odd Lots content, you should check out our daily newsletter. You can find that at bloomberg.com/Odd Lots.
And you can chat about all of these topics 24/7 in our Discord, discord.gg/oddlots.
And if you enjoyed this conversation, then please leave a comment or like the video, or better yet, subscribe.
Thanks for watching.